Sarah, I just want to go to this. On the face of it, low unemployment, well, of course it's great news for Australia, but it's also something of a warning, I guess. You know, you can see the inflation numbers in the United States. I just wonder if that's, if you like, a taste of what's to come for Australia.
It's certainly the case that the US is further along in the cycle, if you like. I mean, rather basically, their economy reopened post-COVID much earlier than ours. We were still in lockdown this time last year. They very definitely weren't. But you're right, it is a sign of when an economy runs hot for a consistent period of time and your labour market's really tight for a consistent period of time, which is what they've experienced. You do ultimately get the wages pressure coming through, and that then feeds into the price pressures. And I think your previous commentator was right to note that those price pressures are broadening. It's beyond food and fuel and other commodities, which are very influenced by obviously other factors globally right now. It's when it gets into those domestic second round effects that's when the Fed, the RBA and other central banks are going to start to worry. So I do think that the labour market data today, very, very positive. It gives them further ammunition, if you like, for the RBA going by another 0.5 percentage point increase at their next meeting. And what will be really, really crucial for me is what happens in that June quarter CPI print, and if we see broadening price pressures here as we've seen in other countries.
I was going to ask you about that because, you know, we have seen even the influence of falling inflation in some areas. So the United States has reported falls in not only oil prices, but in lumber prices, in other prices as well. So at what point is it really, I guess there's the secondary inflation that you talk about. You can see here copper prices down 33%. So there's some deflationary aspects coming out as these prices fall.
Yeah, absolutely. That's what's going to be really interesting to track over the next year, really, with the inflation numbers. The headline rate is likely, I think it's got further to go in terms of peaking here in Australia. There's some specifics that are going to come through. There's more that we're going to measure in terms of those fuel prices. We've got the rolling off of the fuel duty cut that will kick in the next quarter. And, of course, the electricity price resets as well. So there's stuff that's coming through that's going to keep things going for a while in that commodity space. But you're right, as we go through next year, I do think we'll see headline start to ease, assuming nothing else happens. But it's that core, if you like, those domestic pressures that the RBA are going to be really concerned about. That's where it gets into inflation expectations, into wage setting. That's what they're going to be looking to control. So it's not going to be enough for the commodity prices to roll off, which, as you said, they already are, and that will start to feed through. It's going to be making sure that we don't have those indirect second-round effects really embedded at a higher rate. And yes, you know, going from, say, for the US, coming down from 9 is going to be very welcome, but there's an awfully long way to go from 9 to 2, say, given their target. Similarly for us here, if we do get up to that 7 to 3 is a long way, and it's that transition that's going to matter.
I was going to make that observation, why these employment numbers today are so important. Not only are they good news because people have got jobs, and that's always a great story, but the reality is that until now, we haven't really seen wages inflation in Australia. And as you point out, it's that's going to really cause the Reserve Bank or the Federal Reserve or the Bank of Canada or the Bank of New Zealand to react, isn't it?
Yeah, and that's a really good point. I mean, obviously our data comes out with a lag. We're still working just off the March quarter, which feels like an awfully long time ago right now. You know, what we can see and hear in the anecdotal reports and some of the data is that we've got obviously the national minimum wage reset at much higher, the award wage also much higher. And feeling anecdotally talking to some of my clients and what the RBA hear as well, it looks like private sector wages that get reset, traditionally a lot of them in the middle of the year, they're going to be lifted by 3.5% to 4%. So that's another step up too. Now, that's not to say that that's where the WI will print for the June quarter. I don't think it is. There's others. Wage setting is going to be lower. Some of the agreements signed last year will be a bit lower, for instance, and some of the state governments as well. But clearly, we're starting to step up. And we know, again, looking at the US, their wages growth is running at over 5% now. Same thing in the UK and in other economies that are really, really tight, where their labour markets have been tight for some time. So that relationship between tight labour markets and it getting into wages, it is there ultimately, and that's the thing that, as you say, the central banks are responding to. So we should expect to see wages growth picking up as we go through this year, even though our data comes out with a lag.